Welcome back. At 8:30 a.m. Eastern Time today, new inflation numbers, consumer price index numbers, were released by StatsCan. The CPI climbed 1.9% in January over the month of December. This comes after a 1.8% rise in December. I should say the annual pace was 1.9% in January. That comes after an annual pace of 1.8% in December. Let's talk to an expert about it who believes the Bank of Canada is a little bit less likely to cut rates in March at its next announcement. Joining us now from Calgary is Charles St-Arnaud, chief economist at Alberta Central. He's also a former economist at the Bank of Canada itself. Charles, thanks a lot for joining us. You've characterized this inflation report as a tug-of-war between the GST holiday, pushing prices down, and increased prices in the energy basket, pushing prices up. What else did you see in this report?
Yeah, well, when we start looking deeper, because obviously the GST was kind of the big impact that we saw both in December and now in January. We've seen also the increase in energy and when you saw the drag from GST, the increase in energy, we got inflation that stayed roughly unchanged. But when we start digging deeper, there's some concerning pattern. And one of them is that when we look at the momentum in price change, especially in the Bank of Canada's measure of core inflation, we're again above 3% for a fourth consecutive month. That means that if those price pressure that we've had over the past 3 months were to continue for for a year, core inflation will be above 3%, so above what the Bank of Canada wants to see or above its target.
Okay. And you do believe that the bank is less likely to cut in March than it was before, correct?
Well, with that is that it creates a bit of a sentiment, actually, at least at the bank, is that underlying inflationary pressures are stronger than what they were expecting or what they would like to see. And we see it also if we look at the measures, for example, of CPI excluding indirect tax, which would exclude the impact of the GST holiday. It increased by 2.6%, which is quite strong. Still below 3%, but considering that measure was at 1.7% in November, it's a strong acceleration in CPI excluding the impact of taxes.
And when I look at my Bloomberg terminal, in fact, the market now pricing in only a 35% chance of a rate cut at the March 12th meeting of the Bank of Canada, a 79% probability of a cut on April the 16th. You've got to go all the way out to June now before you get to in the opinion of the overnight index swaps market, a 100% probability of a rate cut. So what is your view now of the Bank of Canada versus the Fed? The Bank of Canada certainly expected to cut more often during 2025 than the Fed. What's that mean to the Canadian dollar? What's that telling us about the two economies?
Yeah, well, I think what it tells us for Canada is that in some ways the job at the Bank of Canada, it's becoming a bit more complicated because we know that the uncertainty from the tariffs will have some negative impact on growth. A lot of businesses are likely to be either freezing their investment or postponing or even canceling investment, and that will have a drag on economic activity early in 2025. But now that inflation is stickier, it's less of a done deal that, well, yeah, normally they would have cut to help the economy considering the headwinds, but now with sticky inflation, they have a bit less of that impetus. So they will have to wait and see and have a clearer view of what's going on in early 2025 before they feel comfortable to really cut again.
Are we
in terms of
Are we at risk at all, Charles, of a stagflationary environment where inflation is stubborn, if not rising significantly, at least stubborn, and economic growth is retreating?
Yeah, well, I think stagflation is probably a big of a word at the moment. Like if inflation was to get sticky around 3%, it will mean that the Bank of Canada will have less of the ability to cut later this year, but the economy will still gonna slow. We have the population slowdown that will actually kind of create some more drag. So the Bank of Canada will have to cut more later this year. The question is, it might be slower than what was expected. So that means that in some ways, the rate differential might not be widening as fast as the market was expecting. So that could help, and we've seen it in recent days. It's been helping slightly the Canadian dollar.
Charles, thanks as always for your insight. We always welcome